Hello and welcome to a special show on Economic Survey 2026, and this year's Economic Survey, India's growth is pegged at 7% potential, and more importantly, first time the survey has quantified global disorder. It is not limiting to that, it has also highlighted that interest rates lowering cannot alone fix the capital problem, but more importantly, the inflation is likely to remain benign, and that is the word which came in from CEA Nageshwaran as well. Let's go across and listen to the bite first, what exactly he said in press conference, and after that we'll have a discussion on the economic survey.
Consumption and investment spending amidst very moderate inflation environment. This year, it is projected to be about 1.7% on average so far for the first 9 months of the year, largely due to a deflationary trend in food price index. However, it's important to note that core inflation is also well behaved. If you take out gold and silver, core inflation is 2.9, well below the 4% threshold with which the headline inflation is pursued by the central bank. So we basically have benign inflation trends, which we expect to see continue in the next financial year as well. More importantly, the primary deficit, which is revenue deficit minus interest payments, has come down from 5.7 and expected to be 0.8% this year. We achieved it through improvement in tax buoyancy, tax collections, while increasing and improving the quality of expenditure.
And we're joined by an esteemed panel of guests this afternoon to try and discuss and dissect everything that's come out as part of the Economic Survey 2026 and what that will actually hold in store for the budget. We're joined by Sakshi Gupta, Principal Economist at HDFC Bank. We're joined by Siddharth Sanyal, who is economist at Bandhan Bank, and Mr. R. Gandhi, who is the former Deputy Governor of the RBI. Mr. Gandhi, let me start with you with regard to your view first off. This growth clip of around 6.8 to 7.2%, you'd call that slightly ambitious first off. Let's try and understand where it sits in terms of how you see it and what will it take to achieve that. What are the current headwinds that the economy is facing which need repair, which could probably help us get there?
Yeah, thank you. First of all, of course, the survey clearly indicates that in the coming fiscal, we can expect a growth of 6.8 to 7.4, on an average 7% growth. So what is likely to be supporting that kind of growth? It clearly mentions, and I also fully of the view that inherent strength in the Indian economy, domestic factors, be it domestic consumption getting steadied and capital formation again going on steady. These kind of and macro policy parameters, macro stability, all are in favor of growth. So that potential growth to be at 7% is definitely a realistic estimate. That's what I would support. And yes, obviously, external sector uncertainties are highlighted. That's it beyond the factor. But your question relates to what underlines the confidence in terms of growth being in the range of 6.8 to 7.4. That is entirely due to internal factors.
Right. I want to come to you, Siddharth, for the next question. It has been highlighted in the economic survey that the steps which has been taken so far are not sufficient as far as this growth projection is concerned. I'm saying nobody is doubting the 7% growth because 8% we have already achieved in the first half. But more importantly, it is also putting the responsibility on government side and not just RBI. How do you take that?
Well, that's very significant. I think there is actually one more aspect that they are not only talking about this particular financial year, they are also giving a guidance, and it looks like about the medium term also, and consistently achieving somewhere in the vicinity of 7% year after year. Government and the policymakers seem to be a lot more confident. Now, this is of particular importance given the kind of volatility we are seeing in the global arena. Despite that, it actually underscores the confidence of policymakers that the domestic factors are strong enough, exactly the way just before me, the way Mr. Gandhi explained so very nicely, that actually there is that momentum that is quite palpable at this moment, and in terms of the domestic factors, which is providing a lot of confidence for the government and policymakers in general. What is actually adding to the confidence of theirs is that some of the long-term reform measures that they have initiated, which is noteworthy, and also some of the basic economic health seem to be well in order. Inflation seems to be low. Fiscal deficit, they seem to be very, very committed. And external sector deficit also is well under check. That is possibly the source of this particular confidence over the medium term.
Sakshi, what could the risks to this kind of a growth estimate be, in your opinion? And how can the budget likely seek to curb or reduce some of those risks?
Right. So, the other panelist has spoken about a lot of the positive factors, of course, that have come out in the economic survey. But you mentioned risk. So I think the economic survey does a good job of also highlighting the fact that on the external front, right, and they have laid down 3 scenarios where they are talking about the fact that, the best case scenario could be that on the external front, things continue as they were in 2025, which means that you have a lot of the lingering uncertainty from, trade, tariffs, geopolitical tensions, etc., that continue to play out. So if that is, something that plays out for 2026, then clearly the impact on our export side that we have currently not witnessed could kind of start having a drag on this growth estimate of between 6.8 to 7.2%. Secondly, I think the economic survey also talks about the fact that, look, you could end up with a 40 to 45% probability of things escalating from here on. And while our domestic fundamentals, on the external front, but while our domestic fundamentals seem to be holding up well, we will not be completely immune to any increase in global shocks. Right. And I would say that a 45% probability is significant. And to that extent, the impact that we've seen on the rupee in terms of the capital account, and therefore consequently issues around domestic liquidity, rate transmission, credit growth, I mean, all these things follow. So I think there is still fair amount of uncertainty regarding some of these variables. And therefore, in this context, I think the budget, this is an ask, of course, and hope that there is some focus on, creating greater confidence, of course, in the near term around India's macro fundamentals from a policy perspective, and also to be able to attract capital into India and investor interest into India, right? Be it through rationalization of certain taxes. I mean, there's been discussion around the withholding tax or capital gains tax, how you kind of treat capital flows into the bond market, the corporate bond market, etc. So many of these issues. So I think that is clearly a policy ask from this budget. And of course, while they are consolidating their fiscal math, I think they have to kind of also lay down the next steps in terms of improving things like skilling, labor productivity. These are also
Right.
issues that the economic survey kind of talks about.
Definitely. I want to draw your attention, Mr. Gandhi, towards a specific chapter this time, which is highlighting that the capital issue is not just lowering rates, but it is a structural problem. I want to understand from you, how can actually government fix this problem? And do you think this budget 2026 is going to be an opportunity for that?
Yeah, exactly. Because economic survey puts a lot of emphasis on that aspect. Just now, Sakshi they explained also. Because in the coming year or in the medium term, the survey predicts external sector wise, it predicts a pessimistic view, in the sense that in all the 3 scenarios which it explains, everywhere it is something negative, saying that it is either it's a managed disorder or disorderly breakdown or the systemic shock. 45 probabilities of the first 2, and the last one 10 to 20%. So that way, all the 3 scenarios, it is going to be difficult. That means that, and it also laments that despite all the macroeconomic performances, positive features that India has, the world has not rewarded us in terms of currency stability, capital flows, and strategic nation, etc. So that means that's why the policy, the survey focuses on the cost of capital. If it has to be reduced, it has to be through a consistent policy of export surplus. As a surplus economy, we should be trying to achieve that stage. That can be done through policy certainty and policy predictability. These two are very important. That's what in the coming budget we should be expecting quite a bit. The world over, the foreign capital will be highly appreciating these kind of efforts that we bring in. That will give the sustained foreign exchange inflows into us, and that way, in due course, we can become surplus. To become surplus economy, it is not sufficient to attract foreign capital. Equally important is to increase the production competitiveness in the market today. So that is that also survey puts a lot of emphasis and ideas for increasing the capacity, especially in industrial sector, because that is what is going to be on a sustainable basis to make India a surplus, BOP, not BOP surplus, in the sense that current account surplus. If we have to achieve, we should be achieving productivity gains, efficiency gains through a lot of measures.
Siddharth, brings me to a pertinent point, right? There's limited fiscal room, and there's a large need to try and unleash some amount of animal spirit, especially with regard to both capex as well as especially in the manufacturing space, because that is where the low-hanging fruit with regard to getting the current account deficit right could well be. How should the government play it through the budget?
Well, that's indeed a very pertinent question and a very interesting one too. If you see of late, the way the government has played it till about, in the last few years, there was a lot of push on infrastructure creation, etc., where the government budget was trying to do some kind of a heavy lifting. So far as the investment momentum was there, it was just after the COVID scenario where the general investment momentum in the private sector had been particularly subdued. My sense is that since last budget onwards, or this particular year onwards, there's a very significant rebalancing in that particular approach that we are witnessing. What is happening at this moment is that the government has played that role for about 2-3 years, have done a lot of heavy lifting in terms of large infrastructure projects. But now, if you see the fillip or boost to the stimulus to the economy is coming in some other form also. This particular year had been a year where there had been very significant tax reduction, first on the income tax side, then on the GST side. Both will likely put some kind of a tailwind generate some kind of a tailwind for consumption momentum, or in general, at some point of time, it's expected that some amount of better sentiment about private capex will be coming back. At this moment, it looks like the government will be investing a lot in terms of boosting the consumption momentum, which had been relatively low in some of the previous years or in recent past. Now it has started improving, and once that improves, possibly the capacity utilization levels in industry goes higher, and that brings in the animal spirit that you are talking about in terms of bringing in more and more capex. Having said that, I would like to highlight one particular point. Private capex actually had been relatively subdued for a significantly long period of time. We need to see that how quickly it starts reviving, because that's the next important piece that we are desperately looking forward to.
All right, that is something which will be watched out for. Siddharth, Sakshi, and Mr. Gandhi, stay with us because we are going to take a very quick break. But after the break, we'll continue discussion on economic survey.
All right, welcome back, and we're in critical conversation with regard to everything that's come out in the Eco Survey 2026, and we have with us Mr. R. Gandhi, as well as Sakshi, as well as we have Sanjeev as well, who's with us. Sakshi, let me come to you, and let me put things into perspective. We've got plenty of uncertainty geopolitically, and therefore, the last year or so, we have had some impact with regard to government revenue. The government has given benefits to consumers, and that flow through has already started to happen. The pickup also has started to happen. How, in your opinion, is the government going to fine balance the budget, and how important is the fiscal deficit number going to be in an environment like this? Should the government prioritize pushing out heavier capex and thrust on consumption, or should fiscal discipline be maintained?
Right. So I think that the ideology with this government, how I read it is that there is this focus towards consolidating the fiscal deficit at the central level. I think that is a strategy that has its own merits. And I think that the government is likely to continue down this path. And this year, they are going to start targeting debt to GDP ratios, right? So we are estimating that they are going to target a debt to GDP ratio close to 55% of GDP, currently from 56% estimated for FY26, which should boil down to a fiscal deficit number of 4.2%. I think that this number should allow the government space to at least maintain, the capital expenditure targets anywhere between 11 to 12 lakh crore, which is still a significant number. Although I don't think that they are going to kind of target very high double-digit growth on the capital expenditure side. And, clearly, as Siddharth was talking earlier, I think the buck is now going to be passed to the private sector and getting more private participation in the, capex revival story for India. Secondly, you mentioned about the tax bit, right? We've seen income tax and the GST cuts. Of course, this has had an implication for the fiscal math for this year. But as we move into FY27, nominal growth is going to start inching up. So this year, nominal growth was just about 8%. The next year, with inflation also kind of stabilizing towards 4, and with real GDP growth somewhere around 7%, I think that at least from the nominal side and in terms of tax collection, etc., things should start looking slightly better than the trends that we saw in FY26.
Right. Mr. Gandhi, I want to come to you now. This survey has particularly highlighted the AI financial risk, the investments which has been done in the infra. You have been in the shoes of the regulator, now wearing that hat, and I want to understand from you how much of the financial risk you see that it can pose to the entire system, and what preparedness should be there.
Okay. This AI phenomenon, which has been highlighted by the survey, especially that is more specific to the international financial market. That valuation, high valuation that is happening is in the international market, not in directly in India. Yes, India is trying to, are hoping, are building quite a lot of capacities in terms of supporting the AI expectations of the world. So it is gearing up, our IT sector is gearing up for taking good advantage of that opportunity. That is definitely there. But the valuation, if you are talking about market valuation, it's a high valuation that is in the West, in the West, and more specifically in the US market. So in case the survey foresees that there could be a kind of burst in that kind of evaluation, then there could be impact on the markets, and spillover effect could be in on Indian markets as well. So that we will not be able to avoid that spillover effect, but it will be a secondary effect. So it should be manageable. Because our own other inherent strength of the Indian economy should be the counterbalancing to some extent of that shock getting absorbed in India. So that's why I'm not very much pessimistic about the AI burst if and when it happens on Indian market. It will be a manageable one It will be there. The impact will be there, but we should be able to tide over it.
Sakshi, how should we maneuver through the kind of foreign currency headwinds that we're facing sitting here out of India? Obviously, the currency is depreciated. How do you see the challenges in terms of currency, and what should probably the steps be to try and overcome them?
Right. So look, one of the things is that what is working for India this time around compared to previous episodes of currency weakness is that our current account deficit currently is very, very low, right? At 1% of GDP on the current account deficit, it is very manageable. I think the problem has been on the capital account front where you have not seen enough capital come in, right? Both from the perspective of net FDI this year as well as FII flows, which have actually been a net outflow if you combine the equity and debt numbers. So ultimately, I think it is a combination, as I said earlier, policy stability, attracting capital, for this year, and then managing, and the RBI has been doing a good job of at least stabilizing the currency to some extent, given the extent of headwinds that we are facing. One of the things I want to highlight from a currency perspective is that the economic survey talks about two things, right, on our external, account front. One is that they are arguing that currency depreciation in itself perhaps is not such a bad thing, right? So in a situation where you are facing tariffs and so much more global protectionism, some amount of weakness in the currency does help your export competitiveness to the extent that it is orderly in fashion. Secondly, they are also saying that, look, if you want to kind of stabilize your currency over the
Right.
medium term.
Right, Sakshi, point
Yeah.
well taken. Due to paucity of time, I'll come for the one last question to you, Mr. Sanyal. Tariff has been mentioned in the economic survey, and the expectation is that this year we should be through. But having said that, what are the steps you think which can be announced by the government in the budget to offset the impact of tariff and also prepare ourselves for the future deals?
Well, one particular something very important is that we should continue to focus on fundamentals, and the government had been doing that, not focusing too much on a knee-jerk solution, which has also not been the style. So I'm very optimistic that way. We'll continue to focus on fundamentals and will not try to adjust it in a knee-jerk fashion. In terms of support from the budget, I think we might actually see a little more of incentives towards export-oriented sector, little more incentives towards MSME sectors, etc., who are often big in both employment creation and exports. Some of these measures I would definitely like to see from the budget. But apart from that, outside the budget, we need to have a lot more bilateral agreements, etc., which had been seen decent momentum of late. So I remain somewhat optimistic on that particular front as a whole.
All right, viewers, that brings us to the end of this very, very engaging conversation. Sakshi, Mr. Gandhi, Siddharth, this has been really good fun. Thank you so much for coming in and giving us your views and your perspectives. Kind of rounds things up very, very well in the run-up to Budget 2026. One of the more awaited events, one of the more awaited budgets, Ankur, if I can call it that.
And more importantly, this time, the eco survey is clearly saying that structure of the economy is more important than speed.
Absolutely, and they will have to balance both the short term along with the long term. So plenty to look forward to. We'll see what moves happen come Sunday. But that brings us to the end of this particular show, a very special show on Eco Survey. Thanks so much for joining us. Stay tuned to ET Now. More action on the other side.